This is a discussion about the accounting equation. The accounting equation is assets equals liabilities plus equity. The four financial statements that you looked at in the previous video are all built around this formula. So if you know what assets and liabilities are, then you know what equities are. And if you know what equity and liabilities are, then you know what total assets are. Okay. This equation always has to remain true. So you should remember, like over and over and over again, as you jog around the field, as you exercise, assets equals liability plus equity. You should say it over and over and over so that you're thinking it when you wake up in the morning. Assets equals liability plus equity. Now, let's jump and talk about what are assets, what are liabilities, and what is equity. Assets are defined as resources of a company or economic resources of a company that will help it generate future revenue. Okay. Liabilities are claims to those assets by people outside the company, non-owners, mainly creditors, banks, anybody the company owes money to, because those people think they have a theoretical claim to those assets. Liability represents the owners of the company. Let's jump back to assets and talk about different types of assets. The first one that comes to my mind is cash. And when we say cash, we just don't mean the green stuff that's in your wallet. We mean what's in your checking account, what's in your savings account, what's in your money market account, etc. The second asset I'd like to talk about is accounts receivable. And what these are amounts of money that you will receive from your customers for which you have already performed services or sold goods to. So hopefully in a very short amount of time, these accounts receivable will turn into these assets. The third type I'd like to mention is inventory. Inventory are goods that are sold by a company that sells goods to its customers. A good example of that is if you go to Best Buy and you look around at the iPods, at the laptops, those are its inventory. Those will hopefully convert into accounts receivable and or cash. Another type of asset I can mention is land. That's simply real estate that a company may own that will help it generate revenue and to help it generate cash. Along with that, I could list equipment as an asset. And there's a lot of other different assets. There are intangible assets. Let's say you go and you buy a patent. You buy software, which by itself has no tangible property. Okay. But these are some of the basic assets that you may see. Let's jump to liabilities. Liabilities, again, are money owed by the company to people outside the company. Okay. So similar to accounts receivable, there's accounts payable. When you see the Office Depot truck delivering office supplies at Mills College, what happens is that they're dropping off supplies. Mills College is not giving them a check or cash right away. To Mills College, they owe Office Depot money. That is an accounts payable. Now, one hint I can give you is that all these liabilities tend to have the word payable in there. Okay. For example, you could have a loan payable. So you go to the bank, you borrow money. That is a loan payable. Sometimes it's called a notes payable. It's called a notes payable because you sign a piece of paper, a note, that you owe money. And there's all sorts of different types of payables. There's wages payable, salaries payable. There's also sales tax payable, income tax payable, all sorts of different payables. But let's stick with that for now. Now let's move to equity. Equity can be divided into two pieces: capital and retained earnings. Okay. Capital is the investment that the owners made in the company. The most typical type of capital is called common stock. At least it is for a corporation. And there's also other types of stock. There's something called preferred stock that we will take up later on. Retained earnings is almost self-descriptive. Is the earnings that a company has made and has retained. So when a company makes money, oftentimes that money gets distributed to the owners. That is called a dividend. Now, one important thing I want to mention about dividends is this, and you might want to write this down. In fact, you might want to write this down 10 times. Dividends is not an expense, and you'll see what I mean in a little bit. Again, dividends is not an expense. This ends our talk on the accounting equation.